Hey everyone, Happy New Year. Thanks for taking a few minutes to watch the video. This will be my 2022 mortgage outlook forecast, I guess. It's going to be, I think, less of a snoozer than it was last year. There was really very little volatility in the market last year, and I think there's going to be more this year. I think it's going to be a matter of picking your spot. If you're talking about a refinance, I think it's going to be a matter of picking your spot and not getting panicked, because I definitely think that there will be some lows in mortgage rates, of course. And I also think that there will be some times where you will see rates um, rise pretty significantly in a short period of time. And the general narrative may lead you to a place of concern and even panic, thinking that if you don't do something now, rates are going to run away forever. Um, and I don't think that's the case. So while there may be some pain to the upside in mortgage rates in the coming year, ultimately, I think it's going to be short lived, and don't panic into something that you may regret later just because you think rates are going to continue to rise in a straight line. If there's one thing that I urge you to remember is that nothing goes in a straight line forever. Absolutely nothing. So, with that, let me get into it. I have a little slide deck here to share with you. So, I'm going to see if I can successfully share this slide deck with you. Let's see, which screen do I want to go to? Hey, look, I got it right. Here we go. This is my 2022 market forecast. Happy New Year. Let's go. So, 2022, the Federal Reserve is going to play a major role in the market, which is unfortunate because they shouldn't be in that position. They shouldn't be the center of the universe. But through their own actions since 2009, they've made themselves the center of the universe. It's rather unfortunate. I could go on a long tirade, really, of what is wrong with that, but that's a different talk show. So we'll just say that the Fed is going to play a major role in 2022. Of course, they've already talked about tapering and rate hikes and running off the balance sheet. All of these things will impact equity markets. And while everybody knows, or at least should know, that the stock market is not the economy, um, the Fed doesn't seem to think so. And the Fed is very focused on the stock market. Their action over the last decade plus has proven that to us time and time again. So these actions that the Fed is talking about taking and has begun taking will have an impact on equity markets. Of course, they will drive interest rates. Now, remember, the Federal Reserve doesn't set mortgage rates. It doesn't set yield on U.S. Debt. What it does is it sets the Fed's what's called the Fed funds rate, which then has an effect on those things. It's a downstream effect. It's definitely a driver, and the Fed will drive interest rates. And of course, interest rates will impact housing as well as jobs. Okay. Now, some members of the Fed board will rotate this year. There will be some turnover. So there will be a different voting body at the Federal Reserve. But don't forget that ultimately it comes down to the chairman. And at least at this point, having received his renomination, it looks like Jerome Powell will be the Fed chair for at least one more term. Now, the narrative is going to say that the Fed is fighting inflation and that is its main focus. However, don't forget that the Fed wants a certain level of inflation, because inflation is the thing that will help them with all the debt that's being created. Inflate away the debt. I'm sure you've heard that. If you want to learn more about that, give it a quick Google. But the Fed wants a certain level of inflation, and it's probably a higher level than the 2% target, which they talk about all the time. But if they say that, well, then of course they're going to get backlash from those who inflation hurts the most, which is the majority of us. Now, it's negative stock market reaction, as I just mentioned. The Fed has the stock market in its sights, its main focus, and a negative reaction from the stock market could cause the Fed to lose resolve and lose resolve quickly. Quickly. Here's a term to remember for the year: the Powell pivot. I think we're going to see it at some point this year. I'll talk more about that in a minute. All right. Now, of course, in hindsight, we all know the Fed should have hiked sooner, especially with continued fiscal stimulus that came in 2021, but they didn't. They kept their foot on the gas throughout the course of the year, just pumping liquidity into the markets. And, until recently, Jerome Powell stood by the word transitory when referring to inflation. It was just in the fourth quarter of 2021 that he, quote, decided to retire the word transitory. So, history in regard to the Fed can maybe help us see what 2022 might look like. Because, yes, we have been here before, as they say, history never repeats, but it certainly rhymes. And I believe that wholeheartedly. Now, back in 1970, in the 1970s, of course, was the last real major bout with inflation that we've seen in this country. A lot of things happened in the 70s, and we've seen inflation since, but not at the level that we saw in the 1970s. So, who was Fed chair in the 1970s? Well, it was this nice looking, smug gentleman right here. His name is Arthur Burns, and he was the Fed chair. He ignored inflation in the early 70s and mid 70s, which was rising rapidly, much like it is today. Instead, he planted his flag and said inflation would be transitory, much like Mr. Powell has done until recently. Well, year over year, inflation went from 7% in 1978 to 14% by the time Mr. Burns left the chair in 1980. Enter there's more. Burns, of course, remained steadfast that inflation was transient, and the higher inflation caused mortgage rates to go from 12 to 18%. Seems absurd in today's 3% realm, right? Well, following Mr. Burns, here we go. Enter Paul Volcker. Big fan of Paul Volcker because he did the unpopular thing, but the thing that needed to be done. He hiked the Fed funds rate from 11 to 20% in the course of 24 months. And of course, his reason for doing that was to fight inflation. Higher rates, lower inflation. Well, inflation did fall. It went from 14% when he arrived to just below 5%. And because inflation dropped, as did mortgage rates, they sharply declined. Because remember, inflation is the enemy of anything yield bearing, and your mortgage is a yield bearing instrument. Somebody gets a return for holding that mortgage, and if their rate of return is locked in a time frame, a prior time frame where inflation wasn't as high as it is today, well, the return on that investment is basically eaten by inflation. Yeah, it buys them less. That rate of return they're receiving from a home mortgage goes less far for them. So it is inflation is definitely the enemy of mortgage bonds. And because inflation dropped, well, mortgage rates dropped as well because a lower return on that mortgage will then go further for the investors that hold them. But with every action comes a reaction, right? There's consequence. And the S&P declined very sharply, 30% during this time. And a tighter monetary policy, which is what rising interest rates are, pushed the U.S. into recession in the early 1980s. But Paul Volcker did what Paul Volcker had to do. And let me assure you, Jerome Powell is no Paul Volcker. Well, after Volcker, enter Alan Greenspan. He became the Fed chair in the late 80s, and he was there for quite some time. Into the late 90s, inflation doubled from 1.75% to 3.5%. And inflation caused mortgage rates to rise for the reasons I just spoke about. But unlike Burns, Greenspan took action almost immediately. He raised the Fed funds rate by 1.75, which matched the pace of inflation, which took it from 4.75% to 6.5% in the course of a year. And he was successful. Inflation responded and went from 3.5% back down towards 1%. Well, and mortgage rates dropped, again, for the reasons I just mentioned, from 8.5% when he started the hike cycle down to 5.5%, late 90s, early 2000s. You may recall, big refi boom back then. But there were consequences. That's right. The S&P fell by 50% from the spring to fall of 2000, and the U.S. entered a recession. You may know this or recall this as the tech bubble. And there's a reason, back in the late 90s, early 2000s, the onset of the internet, anything with the word .com in it had an astronomical multiple assigned to it. And the fact that interest rates rose had something to do with the popping of that bubble. And I only mention this because we're in a very similar position today. There's a high correlation between low interest rates and in the return of NASDAQ stocks, tech stocks, growth stocks, because innovation takes financing. And the cheaper you can finance innovation, as in tech, the lower the cost of money, the more innovation progress you can achieve. And it kind of boiling it down to the simplest explanation, but with a lesser cost of financing, well, you can achieve more innovation and earn higher return on that innovation because the cost of the innovation has been less because the cost of the money to finance that innovation has been less. So when interest rates rise, well, those high-flying stocks like tech stocks tend to get hit the most. And we're in a real similar position today, just worth noting. So we move on to today. We all know this guy. This is Jerome Powell, J. Powell, depending on which news channel you're watching. In 2021, inflation went from just under 2% to 7%. Quite the jump, and until recently, Powell thought it to be transitory, blaming it on supply chain issues, which we have all heard about extensively in the last few months. And inflation did cause mortgage rates to rise a bit, from 2.5 to a little over 3%. It would have been more of a more dramatic jump had the Fed not been in there manipulating markets, buying mortgage-backed securities. And make no mistake, that's the business the Fed is in. The Fed is in the business of manipulating markets. The Fed is currently tapering. I don't know about currently. I'm actually going to restate that. The Fed is currently planning tapering. They really haven't done anything yet except deliver a bunch of lip service. And it has said, the Fed has said, it will not hike its Fed funds rate while reducing purchases at the same time, because, and Jerome Powell did say this, almost verbatim in his last press conference, because the markets are sensitive to those things. So he clearly stated that he is watching markets, not the economy, two separate things. Once they're done tapering in March, the market believes they're likely to start hiking the Fed funds rate. Right now, the market believes there'll be 3 this year and 2 or 3 next year. That is what the market is anticipating. I'm anticipating far less because of the Powell pivot. Inflation and interest rates can still rise. They can still rise until the Fed acts. And even if the Fed acts a little bit, they can still rise. It may take something decisive, like what Volcker did in the early 80s, to really fight inflation, especially the longer the problem remains, the harder it is to fight, like most things, right? If the Fed can tame inflation, mortgage rates should drop, but maybe from higher levels. And I do think mortgage rates will see a few bouts this year of spikes higher. But I also think mortgage rates have the potential to drop regardless of Fed action, mostly because of the effect well, I guess because of Fed action, but because of the Fed action in its effect on markets, on equity markets. So let's take a look at the pattern here of the last 3 or 4 Fed chair. And I hate the fact that we have to talk about the Fed so much, but unfortunately, they are a big part of what this year is going to end up looking like for us. So back in the 70s, Burns, and early 80s, Burns and Volcker, inflation went from 7 to 14%. Greenspan saw a rise in inflation as well, although much less. And Jerome Powell, with a pretty sizable one here on his hands currently. Here's where mortgage rates were during that time. Of course, Powell has the lowest mortgage rate of the bunch, currently working just over 3%. And the Fed funds rate, well, currently sitting at 0. Expectation is that it'll go to 1% sometime this year. That would be 3 to 4 rate hikes in the course of the year to take it from 0 to 0.25 up to 1%. So 3 rate hikes this year. If they manage to pull that off, we'll be at 1%. So a little shorter runway, a little less room for error these days, that's for sure. And the response, to those actions? Well, back in the 70s, had its intended response. The Greenspan era also had its intended response. Greenspan took inflation from 8.5 all the way back down to 1. And while we don't know what's going to happen in the current situation, all expectations are that inflation should drop. And so should mortgage rates. Um, they don't have too far to drop, being already pretty low by historical comparison. But of course, there's always those pesky consequences, right? Well, when Burns or when Volcker did it, S&P dropped 30%, pushed the U.S. into a recession. When Greenspan did it in 2000, early 2000s, the S&P dropped 50% and pushed the economy into a recession. You notice how those things, the consequence became greater because markets are more dependent on Federal Reserve as time goes on and as the Fed lets the market suck on the Federal Reserve thumb longer, it produces more of a reaction. So, what will be the reaction this year? Well, if Jerome Powell does what he says he's going to do, which is still a little bit up in the air, stocks likely will sell off. Some people calling for at least a 10% correction. I think that is a pretty soft prediction. 10%, I think, should be expected, but I wouldn't be surprised by something much greater. If we get down to that 25% sell off in the equity markets, enter the Powell pivot and we'll find a bottom. The minute the Powell pivot occurs, that is when there is the bottoms being put in. Of course, there's a wild card of COVID. We learn more every day, but there's still a lot we don't know. And if something new comes to light, that could affect all forecasts dramatically. And of course, there's the Build Back Better agenda. That would basically equal more fiscal stimulus, which could push inflation and inflation fears a bit higher, could push mortgage rates a bit higher, and would definitely make the Fed's job a little more difficult. Now, the Fed needs to stop purchasing its bonds and treasuries, which it says it's going to do this month, and then later in the year start hiking the Fed funds rate. But the Fed is still reinvesting money. So as these assets run off the balance sheet, they're taking those returns and reinvesting them. When will they stop reinvesting them? I don't know. I don't know that they can, quite honestly. We'll have to wait and see what happens there. If for some reason they say that they're going to, um, that'll be a bad day for markets. Let's just put it that way. Speaking of markets, by just about every metric possible, our current stock market is extremely overvalued. Extremely overvalued. It's very surprising to me that it has gotten this far, but it has. I mean, everything is just red hot. I mean, there's a PEs in the low 20s across the board, and that's just a little crazy. So if the rate hikes occur as thought, there will be a contraction in the stock market. There's no question in my mind that it will happen because the market is dependent on the Fed's liquidity, and if they take that liquidity away, well, you're going to see what happens. Something else, just off script here. Keep an eye on the junk bond market because that I think is where a lot of Fed liquidity is going. To kind of provide a crutch for the market. So most forecasts say at least a 10% decline. I'm going to say if it's only a 10% decline, we're lucky. I think we could see a 25% decline. At that point, I think the Fed would jump in. Powell pivot would be the headline, and that would be the bottom. So just the minute the Fed falters and the Fed pivots, pull back over. So here we go. What we've all been waiting for. I know there's a lot of talk about the Federal Reserve, but they are key this year, unfortunately. I do anticipate mortgage rates will rise along with inflation during the first part of the year. But there's going to be in the first quarter, there's going to be the first sign of a stock market sell-off. The market's going to throw a little bit of a temper tantrum just to let the Fed know that it's there and it's watching. The market will sell off. and I think that'll be a decent time if you've been contemplating a refi, a cash out, whatever your plans and goals may be. Wait for a pretty decent market sell-off in the first quarter. Maybe we'll get 10% before a little bit of a rebound. Maybe we'll get 7%. I don't know, but that first little sell-off is going to produce an opportunity, and of course, it'll be a short-lived opportunity. So you have to be ready for it. Now, with the Fed action that's coming, expect a softer stock market, as you just said, and a slower economy. Interest rates are going to head higher. I think sometime in Q2, Q3, 3.5%, maybe 3.75 is in the cards. I really do. But basically, what's going to happen is that interest rates are going to push the market to its breaking point, kind of like your young kids do to you, right? They needle, they just poke until you lose it. And interest rates are going to do that to the market. And when the market loses it, that's when the Powell pivot happens. And I think that pivot will happen sometime in Q3 or early Q4. So I do expect mortgage rates to rise. I think they're going to have a few spikes that are probably going to scare some people. I think they're going to be very short-lived, and by the time we're talking next year, I think mortgage rates are going to be, where they are today, possibly even a little bit lower. And if you are purchasing this year, maybe really think about what your goal is and how long you intend to be in this property that you're purchasing. Um, Really think hard about paying points to buy down an interest rate, because I do think in 2023, with all the action the Fed is taking, and history backs me up here, I think 2023 at some point the U.S. may enter recession, and with recession will come a strong Fed response, and zero rates will be back in our lap again. So for this year, for 2022, if you're purchasing a property, really consider not paying points to get that little bit lower interest rate. As a matter of fact, I may take, and it depends on your situation, so please contact me. We'll talk it out. But I may take a slightly higher interest rate to reduce my cost, knowing that in 12 or 14 or 16 months, I'm going to have an opportunity to refinance at a much lower rate, and I get to keep that interest rate credit that helped me with my cost. So don't be too concerned about buying down your interest rate in 2022, because I really believe that 2023, at some point, maybe late 2023, but you're going to have an opportunity to refi at a much lower rate and save those points. All right, save those points. So with that, I do think housing remains strong in 2022. There's a definite demographic equation here that's not going anywhere, but it's not going to be as strong as it was in 2021. Demand will be a little bit softer due to interest rates. Maybe we'll see a little bit of softness in the second home market here in Colorado. That's been a big thing, and interest rates moving just a little bit higher may push that out of reach for some people, but demand will still be robust. Things that will, other things to keep an eye on are the labor market, supply chain, semiconductors, all playing a role. But I think that these things are going to start to fade in the months ahead. But in first quarter specifically, they could still play a part. So here's where we're at. I think housing will continue to appreciate, continue to be a good investment. However, if your expectation is that you're going to see the same appreciation you saw in 2020 and 2021, you may want to recalibrate that expectation. It's still a great opportunity, though, if you can find the inventory you are looking for. I hope this has been helpful to you. It was a little longer than I expected, but hopefully it still provided some value to you. I'm going to pin this on my timelines and here on the YouTube channel, and let's see how accurate I am. All right. Bottom line, rates are going to be volatile this year. There's going to be a few moments where maybe rates approach 4%, and you may panic. My advice is don't. And then by 2023, we're going to see, unfortunately, probably a recession in this country and a better opportunity to refinance. I also think, and I'll just backtrack real quick, I wanted to mention this. I don't think the Fed goes further than two hikes. I don't think they get the Fed funds rate to 1%. I just really don't think it happens. I think the market's temper tantrum keeps them from it. Let's see what happens. Well, I wish you a happy 2022. And if I can be of any help to you throughout the course of the year, if you're thinking about a purchase or a refi, please reach out. Thanks so much for watching. I do appreciate your time.